The best performing investment accounts in a now legendary Fidelity dataset weren't managed by hedge fund guys with Bloomberg terminals. They weren't managed by retired finance professors with color-coded spreadsheets. They were managed by people who had forgotten the accounts existed. And the absolute best performers at the very top of the performance ranking were accounts where the owner was dead. That should be the end of the conversation. But here's the part that makes it genuinely disturbing. In a study of the best performing 401k accounts from 2003 to 2013, those who outperformed everyone else were either people who had died or people who had totally forgotten they had accounts. The accounts were marked as inactive due to lack of trading activity. So the research doesn't say passive investors did well. It says the people who literally could not interact with their portfolio did the best. That's not a coincidence. That's a mechanism. And in the next 15 minutes, I'm going to walk you through exactly what that mechanism is, why it costs the average American investor hundreds of thousands of dollars over a lifetime, and the 3 specific things you can do to stop being on the wrong side of it. Dalbar released its quantitative analysis of investor behavior for 2024, revealing that the average equity investor earned 16.54%, while the S&P 500 returned 25.05%. That 848 basis point gap represents the second largest investor performance gap of the past decade. And despite strong performance in the equity markets, investors continue to underperform due to their behavior. Not their stock picks, their behavior. That is the thesis of this video. And I want you to hear the full weight of it before we go any further. This is not a story about bad markets or bad funds or bad advisors. This is a story about what happens inside the human brain the moment you open a brokerage app during a period of market volatility. Because that moment, that one decision to check, sets off a cascade of psychological events that are well documented, statistically predictable, and almost universally destructive to long-term wealth. Let me give you a metaphor that I'm going to return to throughout this video, because I think it explains the whole thing better than any statistic. Think of your portfolio as a loaf of sourdough bread in a hot oven. The yeast is doing the work. The heat is doing the work. Compounding is doing the work. Every single time you open that oven door, every time you log in because the market dropped 2% on a Tuesday, every time you check the app because someone in a group chat said, guys, the Fed just did something. You let the heat out. The temperature drops. The yeast stalls. The crust that was developing collapses inward. You do not bake better bread by checking it 15 times. You bake better bread by setting a timer and walking away. The dead investors never opened the oven. That is their entire edge. Now, full transparency on the Fidelity story before we go further, because I'm not going to ask you to take anything on faith. The Fidelity study is hard to actually find and has become a bit of an urban legend. Morningstar reached out to Fidelity about it and could not confirm a formally published document. There may be no such formal study. The story apparently originated with investors who forgot they had accounts at Fidelity, but the legend persists because it drives home a point that is independently very well documented. That documentation comes from Berkeley professor Terence Odian, who actually did obtain real brokerage data and publish peer-reviewed research. And when we get to his numbers, you're going to understand why the Fidelity legend spread, because the truth is just as dramatic. In a few minutes, I'm going to show you the exact mechanism inside the brain that makes checking your portfolio dangerous. But first, let me show you the price tag on the decisions that brain produces. Because until you see the dollars, the psychology feels abstract. Individual investors who hold common stocks directly pay a tremendous performance penalty for active trading. Of 66,465 households with accounts at a large discount broker during 1991 to 1996, those that traded most earned an annual return of 11.4%, while the market returned 17.9%. 6.5 percentage points of annual underperformance every year, caused not by picking bad stocks, caused by the frequency of trading those stocks. Overconfident investors trade too frequently, and the gains they realize through trade don't even offset the costs. By analyzing trading records for 10,000 accounts at a large discount brokerage, Odian found the surprising result that, on average, the securities investors purchase actually underperform those they sell. Read that again. The stocks they sold went on to do better than the stocks they bought. Every trade was, on average, a mistake. Not because the investors were unintelligent, because the act of trading itself, driven by the anxiety of watching a number move, systematically produced the wrong outcome. Now fast forward to the most current data we have. Over the 20-year period, ending December 31st, 2024, the average US equity investor returned 9.24% per year compared to the S&P 500 return of 10.35%. That sounds like a narrow gap, but the S&P market portfolio ended up worth 22% more than what the average US investor achieved after 20 years. Here is what that means in actual money. You put $200,000 into an S&P 500 index fund in 2005 and you never touch it. By 2025, at 10.35% annualized, you have approximately $1.4 million. The average active investor at 9.24% ends up with approximately $1.1 million. You produced a $300,000 shortfall entirely through your own voluntary decisions to engage. The market didn't do that to you. Your checking habit did. And this isn't an edge case. 2009 was the last time average equity investors beat the S&P index, meaning average equity investors have lost to the index for 15 consecutive years. 15 straight years of underperformance. Not bad luck. Behavioral drag, compounding the same direction year after year. In 2024, even as markets posted double-digit gains, the average equity investor withdrew 3.23% of assets, the 9th straight year of net outflows. Withdrawals from equity funds occurred in every quarter of 2024, with the largest outflows taking place just before a major return surge. This is where it gets really interesting, because what I just described is the math problem. The math problem is actually the symptom. The cause is something structurally stranger and has nothing to do with emotional weakness or a lack of discipline. There's a number I want you to remember going into the next section. Over 30 years of S&P 500 data, the annual return was 8.4%. I'm going to show you what happens when you remove 30 specific days from that history. 30 days out of roughly 7,500 trading days. Keep that in your head. Over the past 30 years, based on S&P 500 data from July 1995 through June 2025, missing the best 30 days, took the annual average return from 8.4% down to 2.1%, which was less than the 2.5% average inflation rate over that same period. Missing the best 40 days took the average annual return nearly flat to 0.7%, and missing the best 50 days resulted in a negative 0.6% annual return on average. So missing 30 trading days out of 7,500, about 0.4% of all trading days, takes you from 8.4% returns to returns that don't even keep pace with inflation. In real terms, you go backwards. Now here's the structural fact that explains everything. 76% of the stock market's best days have occurred during a bear market or during the first 2 months of a bull market. The market's biggest bounces happen when things look the most terrifying. Over the last 20 years, 7 of the 10 best days occurred within 15 days of the 10 worst days. You cannot avoid the crash without also missing the recovery. They are 15 days apart. The investor who sells on day 1 of the crash because they were checking, because they saw the red number every morning, because the anxiety got unbearable, is with a near certainty derived from 76% of the historical data out of the market on day 16 when it snaps back. For the investor who put $10,000 in the S&P 500 in 2005, missing the 10 best market days would bring their portfolio value down from $71,750. Had they stayed invested through the end of 2024 to $32,871, 10 days. You lose more than half your terminal wealth by missing 10 days across 20 years. Dalbar's guess right ratio, the frequency at which investors correctly time inflows or outflows, fell to just 25% in 2024. 3 out of 4 times an investor made a move based on market conditions, they moved in the wrong direction. A coin flip would have produced better results. By the way, Hit subscribe if you find this useful. The algorithm doesn't show my videos to people who don't engage with the channel, and I cover exactly this kind of documented, source-driven material every week. Here is the part that retirement calculators leave completely blank. Knowing that you're leaving $300,000 on the table through behavioral decisions is genuinely useful. But knowing it and building a system around it are two very different problems. I had the data before I had the framework. The data alone didn't stop me from being anxious during market dislocations. The framework did. I spent roughly 2 years working through 50 years of actual retirement research, withdrawal rate studies, sequence of returns data, healthcare cost modeling, tax drag analysis, the behavioral finance literature, and built it into a digital book called The Exit Code. 8 chapters of research, no filler, built around one central framework, turning maybe someday I'll stop working into a specific date backed by documented math. 2 elements connect directly to what we're discussing today. The first is what I call the dynamic withdrawal method, a replacement for the 4% rule that adjusts based on actual market conditions rather than locking you into a fixed withdrawal rate that can catastrophically fail if the first few years of your retirement coincide with a market downturn. The second is the lazy portfolio section, built on a passive allocation that has historically outperformed active traders over 30-year windows, meaning the behavioral math we just covered has a specific practical application inside a real retirement structure, not a hypothetical one. The full book is available through the link in the description for less than you'd spend on one dinner out. And here's the mathematical urgency I'll mention once. Every year you delay building this framework, the compounding mechanics inside the book are working against you rather than for you. That math doesn't pause. Okay, back to why your brain specifically is the problem. Let me introduce you to a type of investor I've heard from dozens of times. I'll call him Marcus. He's in his early 40s, financially literate, reads about investing, listens to podcasts, considers himself reasonably disciplined. In March of 2020, when the S&P 500 dropped 34% in 33 days, Marcus checked his portfolio every morning, then at lunch, then after dinner. He watched financial news coverage. He read forum threads. He moved a significant portion of his money into cash to wait for things to stabilize. The market bottomed on March 23rd, 2020. The recovery began on March 24th and ran straight into one of the fastest bull markets in recorded history. Marcus was in cash. He missed several of the best trading days of the recovery. He re-entered the market in July after things had calmed down, meaning he bought back in at materially higher prices than he sold. Marcus didn't lose money because markets were cruel. Marcus lost money because he couldn't stop opening the oven. We're going to understand exactly why that was physiologically inevitable, because it has nothing to do with intelligence. Shlomo Benartzi and Richard Thaler's 1995 study introduced the concept of myopic loss aversion, demonstrating that frequent portfolio checks increase the likelihood of perceiving losses, which in turn makes investors more risk-averse, potentially leading to poorer investment decisions. The core finding is that empirical estimates of the loss aversion coefficient are usually around 2, meaning that the disutility of a loss is twice as much as the utility of an equivalent gain. Twice as much pain. Lose $100, it registers as twice as bad as gaining $100. Feels good. That asymmetry is wired into the human brain at a level that rational argument cannot easily override. Now combine that with a base rate of market volatility. The S&P 500 declined on 48.92% of all trading days from 1928 through July 2024. If you're checking your portfolio every day, you may be experiencing the pain response roughly half the time. Not because you're losing money overall. You almost certainly aren't over a long-term horizon. But the brain does not track long-term trend. It tracks today's number versus yesterday's number. And it fires the same threat response system it would activate for a genuinely dangerous situation. Cortisol, anxiety, the impulse to act, to do something. A 1997 study confirmed that loss aversion directly reduces investor returns. From the abstract, the investors who got the most frequent feedback and thus the most information took the least risk and earned the least money. More information, less money. That is a relationship that runs exactly opposite to the assumption most investors operate on. An experiment by 2 Nobel Prize-winning behavioral scientists showed students' investment returns from the same portfolio for various timelines, a month, a year, and 5 years. They found that the shorter the time period the returns were generated from, the less risk the students were willing to take. These results were also replicated among workers who invest in their company retirement plans. The quarterly check lives in a world where the portfolio looks positive 88% of the time. An investor who checks his or her portfolio quarterly instead of daily reduces the chance of seeing a moderate loss of -2% or more from 25% to 12%. Over a 5-year time frame, you have had a 100% probability of markets being up. The daily checker is living in a 49% pain world. The annual checker is living in a world of near certain gains, and their decision-making reflects their perceived world, not the underlying mathematical reality. Here's something that doesn't get talked about in most discussions of investor behavior. One of Odeon's side discoveries was that women fared better than men. The reason was due to trading volume. The average woman in the broker's database outgained the average man by 1 percentage point per year, a hefty sum. 100 basis points per year, compounded over 20 years. Not because women are better stock pickers, because when investors are overconfident, when they think they know more than they do, when they think they're better investors than they are, those investors will trade more, and that trading will hurt their return. Men, on average, are more overconfident. They check more, trade more, and underperform more. The less you believe you can time the market, the less you try. The less you try, the more of the market's actual return you capture. Now let me show you what 20 years of checking versus not checking actually looks like in the same brokerage account. Two brothers-in-law, Dave and Steve, January 2005. Both receive a $200,000 inheritance on the same day. Both invested in the same S&P 500 index fund. Same fund, same day, same starting position. Dave is engaged, checks his account every morning. In 2008, when the index drops nearly 50%, Dave shifts a third of his position into a money market account to protect it. He waits for stability. He re-enters in late 2009, after the recovery has already been underway for several months, at significantly higher prices than where he sold. He makes a similar move during the European debt crisis in 2011. He trims his equity exposure in early 2020. He makes a total of 31 trades over 20 years. Each one feels completely rational at the time. Each one feels like he's being responsible. Steve forgot his Vanguard account password sometime around 2008. Never reset it. Didn't look at the account again until January 2025. Dave, January 2025. Approximately $1.1 million. He's proud of it. He's not wrong to be. That's a respectable result. Steve, January 2025, approximately $1.4 million. Same capital, same fund, same 20 years. Steve won by $300,000 by doing nothing. The bread Dave kept checking never rose properly. Steve's bread, sealed, untouched, left to its own process, was perfect. Your financial advisor sees Dave's trading history and says, this is completely normal behavior in volatile markets. He says that because his fee is 1% of your assets per year, whether you traded 31 times or 0 times. A thermostat doesn't benefit from your drafty windows. Some business models do. Now, here is the level of the problem I want to leave you with, because this is the part that turns from amused frustration into something structurally significant. The market data infrastructure surrounding you right now, the brokerage apps with red and green numbers refreshed in real time, the push notifications telling you a position is down 2%, the financial news networks running live tickers all day, the Reddit investment threads, the social media posts from finance accounts, none of it was designed to make you wealthier. It was designed to keep you engaged. Technological advancements have provided investors greater accessibility for monitoring their portfolios through digital services, such as client portals and mobile apps. But they can also lead to behavior, which causes less obvious investment outcomes, and not always for the better. An engaged investor is a checking investor. A checking investor is, with documented probability, an impulsive investor. An impulsive investor generates trading volume. Trading volume generates revenue for everyone in the chain except the investor. This is the 3-level problem with daily portfolio checking, and it compounds at each level. Level 1 is the emotional cost. Loss aversion fires. You feel the down days at twice the intensity of the up days. You make a decision driven by cortisol that you would never make with a clear head and a calendar review. Level 2 is the opportunity cost. That decision, almost always, some version of reduced exposure, pulls you out of the market at the exact moment it's most likely to snap back. You miss the best days. The best days in the S&P 500 index tend to cluster in the midst of a bear market or recession, when the market is at its most volatile. If you're selling because things look terrible, you are selling yourself out of the days that build most of the long-term return. 7 of the 10 highest returning market days over the past 20 years happened within 2 weeks of the market's largest one-day declines. The crash and the recovery are practically neighbors. You can't live through one without the other. Level 3 is the tax cost, which almost nobody talks about. Every time you sell in a taxable account, if you've held that position for less than 12 months, you pay ordinary income tax on the gains. For most people in their productive earning years, that's a marginal rate between 22 and 32%. The long-term capital gains rate, the rate you pay when you hold an asset for more than a year, is 15% for most middle to upper income investors. Every reactive trade you make in a taxable account is a voluntary tax upgrade. You're paying 22 to 32% instead of 15% because you couldn't wait out a bad week. That tax drag compounds against you over decades with the same mathematical ruthlessness as any other cost. The information you're consuming is not an edge. Investors who look at markets and their portfolios too frequently overemphasize short-term dips and recent bouts of market volatility. This causes them to invest too conservatively for their risk profiles, sacrificing wealth along the way. More data, more anxiety, more conservatism, worse outcome. The entire direction of the relationship runs backwards from what most people assume. Here's the thing that I find most darkly funny about the whole setup. The high-frequency trading algorithms at institutional desks process tens of thousands of transactions per second using price data refreshed in microseconds, running models that took teams of PhD mathematicians years to build. The average investor, stress trading on his phone at 11 p.m. after reading a forum thread about Federal Reserve policy, thinks he's operating in the same information environment. He is not. He's arriving at a chess grandmaster competition with a checkers board, convinced the pieces work the same way. Marcus, the investor we met earlier who bailed during the COVID crash, eventually ran his own numbers, found the Odeon data, calculated that his 2020 trading decisions cost him approximately $40,000 in missed recovery gains. He switched to a single rule: quarterly reviews only, on a fixed calendar date, not triggered by market events. No news alerts set on individual holdings. No brokerage app on his phone between review dates. He told me the strangest thing happened. His anxiety about money dropped significantly. Not immediately and not entirely, but the portfolio stopped being a daily emotional event. It became a background process, something curing, something the yeast was handling. His nervous system was no longer enrolled in the daily performance of his investments. The bread was in the oven. He'd set the timer, he walked away. That's the practical shift. And it's not passivity. It's structural patience, the most unfashionable and most lucrative edge available to a non-institutional investor. 3 things specific to this exact topic. First, engineer the friction. Delete the brokerage app from your phone. Set a calendar. Date quarterly is the research-supported interval, and only check on that date. Checking quarterly instead of daily reduces your probability of seeing a moderate loss from 25% to 12%. That 12-point gap is the difference between an anxiety-driven investor and a patient one. You cannot override the loss aversion wiring through willpower. You have to make checking difficult. Second, build a 24-hour rule for any reactive trade. When markets drop and you feel the urge to do something, open a document. Write down exactly what you intend to do and the specific reason why. Don't act on it that day. In 2024, Dalbar found investors time their moves correctly only 25% of the time. A cooling off period lets the cortisol dissipate. Most of the time, you'll read what you wrote the next morning and decide not to trade. The trades you don't make are frequently your best trades. Third, memorize the best days number and use it when things get bad. If you missed the market's 10 best days over the past 30 years, your returns would have been cut in half. Missing the best 30 days would have reduced your returns by an astonishing 84%. Those days cannot be identified in advance. The only way to capture them is to be in the market when they happen, which means staying in the market when it feels worst, which means not opening the app. Over the past 89 years, through December 31st, 2025, 94% of 10-year periods in the market have been positive. The long-term math is not the problem. The short-term checking is the problem. Those are two completely different problems with two completely different solutions. Lazy investing built more fortune than crypto memes. The dead guys figured it out first. The rest of us are still working on setting the timer and walking away.